Hello and welcome to our workshop today. My name is Albert Ramsey and I will be your facilitator for this workshop. It's a lot of content for us to cover, but hopefully you will take some value away from our time today. Some of the topics we're going to cover in today's workshop on protecting your income and assets are to explain the X-curve concept and why life insurance. And we're going to look at the various types of life insurance. When is life insurance needed or not? Why would a young person need life insurance? And some of the benefits to this in your overall financial strategy. Again, this is part of our financial education workshop series, and we want to make sure that you get a lot of information that will help you to become more empowered to make your own financial decisions. Before I go any further, I just want to make a few disclaimers here. The information in this presentation should not be interpreted as accounting, investment, legal, or tax advice. It is not an offer to sell or a solicitation to buy any security, insurance, or any other financial product. This workshop is for educational purposes only. So I believe all of us would agree that one of our number one goals in life is to be able to retire. And retirement looks different for everybody and could be sitting on the beach like in the picture, but it could mean a lot of other things. Retirement only means that you have a choice whether you show up for work or not. But to do that, we typically have to save up some investments that will give us the income that we need during retirement. So, and for that savings to be possible, we need to work. Most of us work. There are lots of other ways to make money, but most of us exchange our time for money. And when we work, we pay the bills and then we save to invest as well. So this is the cycle that most of us follow. Work, pay the bills, save up some of what's left, and then we have enough that we can retire one day. But what can go wrong with this picture, right? One of the things is that if we are not able to work for some reason, then we have to worry about how the bills are going to get paid. So what we're going to talk about today is how do we protect ourselves from these situations happening. So we're talking about here income protection, right? And there are several ways that a family's income can be severely impacted. And there are three ways mainly. You can get a serious medical condition. You get injured. No fault of your own sometimes, but sometimes you get sick or injured. And God forbid, the ultimate, if we pass away, the death of the breadwinner for the family. Those are some things that can severely impact the family's well-being. So income protection is not only needed to substitute your income when you're alive, but also to pay out final expenses, pay off debts, transfer assets to your family, and so that they can continue with their life. Right. So we've been talking about building a proper financial house, and the foundation of which we talk about is proper protection. And that's what we're going to talk about today. Building our financial house must start with proper protection as the foundation. And then we go on to these other things in the other workshops: debt management, emergency fund, and then investments. So with a strong foundation, we can be a little bit more comfortable and have a more peace of mind that things are protected. So let's look at this concept called the X-curve, right? It's a famous concept or drawing, picture, diagram in the insurance industry. It talks about the need for insurance and why we need insurance. So on the left, we have, when we're young, right? And you'll see this purple diagram, meaning the law of building wealth, and the red, decreasing responsibility. And as we move to the right, it's as we age, right? We get older. As we get older, we build more wealth and our responsibilities will decrease, right? So when we're younger, some of the big responsibilities we have, food, clothing, shelter, all these things we have not yet acquired sometimes, so we have to borrow to pay for them. And, we want to make sure that at this stage, especially if we have people who depend on us, that we answer the question, what if I die too soon? What if you die too soon? And that's when insurance comes in to replace income. As we get older, right, there are other things that will happen. We will start building savings. Some of our debts will go away. People that would depend on us, kids will grow older and become more independent. So our responsibilities will reduce. And the question at that stage is, what if I live too long, right? How will I have enough to live off, right? So we want to make sure that we save up the proper nest egg for retirement so that we can live off the interest only possible, and then we have a better lifestyle during retirement. So what do we mean by proper protection, right? So what are the things that you typically insure, right? We insure several things in our life. We insure the car, the house, electronics, jewelry, pets even. And the fact is that we recognize the importance of insurance. Sometimes we are forced to get it, especially if you own a car. But we protect this responsibility or assets through transferring the risk to somebody else. So insurance is a means of protection for financial loss. We are transferring the risk to an insurance company who looks at the risk and assesses a cost to protect that. This is the form of risk management, and we're giving it to somebody else. So it's just like everything else in life. There are people out there, insurance providers, who will provide you with a coverage that will protect you from financial loss should that happen. And of course, they're pooling their risk across many different people, so they have a way to protect themselves. So continuing on the concept of property protection, we insure a lot of things, house, car, but a lot of times we forget or fail to insure the most important asset of all, which is ourselves, right? Life insurance can protect the loved ones who depend on you from financial burden of losing your income, right? A lot of times that happens, right? People underestimate, how long they can live, or overestimate, frankly, and in exchange for premiums, as I said, somebody's willing to take on the risk, provide that lump sum payment and that benefit to your beneficiaries upon your passing, upon the insurance passing. So we need to make sure that we take care of our loved ones, so it's up to us. And let's look at how we allocate for that, right? Typically, we earn an income, we pay the bills, right? All these bills never go away. They need to be paid regardless. And then we make sure we have some savings. So what we typically propose or recommend is that 10 to 20% of your monthly income is allocated to protecting your family as well as for investments. So in the case of death, there's a tax-free benefit that will help to keep your loved ones going while you're gone, if you're gone. And then we also want to put some away for retirement. And they're not mutually exclusive. We want to do both, right? So we want to make sure we continue to start paying for, put towards our nest egg for retirement, as well as putting the proper protections in place, both from, living benefits and from, death. So let's look at this perspective. This could be what you could think of when you think about a life insurance policy. This is a letter from your life insurance policy. Hello, I am your life insurance policy. You and I have similar purposes in this world. It is your job to provide food, clothing, shelter, schooling, medicine, and other things for the ones you love. You do this while I'm kept in a safe place. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. At times I may appear insignificant to you, but someday, and who knows when, you and I will exchange places. When you're laid to rest, I will come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and other things your family will continue to need, just as you are providing now. When your work and labor are done, mine will begin. Through me, your hands carry on. Whenever you feel the price you're paying for my upkeep is burdensome, remember that I can do more for you and your family than you will ever do for me. Knowing how a policy like me works will help you understand my role in your overall financial foundation. Together, we can help protect the future of your family. If you do your part, I'll do mine. So isn't that awesome? That's pretty much a perspective of looking at your life insurance policy. All right, so life insurance is definitely important for taking care of the loved ones who depend on us, but there are other reasons why that's also important. Sometimes we also give to charities. I would love to make sure that continues to happen if we pass away. We also have estate preservation purposes. We can go into that another time. Business planning, insurance can be a big part of business planning to make sure that the business continuity is there. We also can create wealth and an inheritance for the ones who we leave behind. So, like anything that's not frequently talked about, life insurance can be a tricky subject to talk about. There can be a lot of misconceptions. Do I really need it? Why is it so cheap? Why is it so expensive? What am I getting? Who are benefits? You know, is the code too high? Is it for real? Or are they will they really pay? All these questions are sometimes questions that are asked. And the options can be overwhelming. Sales tactics and all the things can create pressure. And who likes to talk about dying anyway? But today, you clearly understand why life insurance is the most important. All right, so premiums for life insurance. Think about like insuring your car. There are various factors that the insurance company or provider will take into account when you insure an asset like your car or your home, right? Where is it located? Size, cost, all these things. Life insurance is no different. There are various factors that a life insurance company will consider when determining the premium. Your age, your gender, weight and height can be a factor. Health issues, past and present. Medications that you're taking. Tobacco use is a big one. Family health history for some things. Driving record and high risk activities, right? So the question is, are you still insurable? Right? A lot of people don't realize that they can become uninsurable as time passes. Who knows when one of these things may cause you to become uninsurable. Right? So as I mentioned before, premiums are determined by several things. So let's do a little quick recap. If I put up this list on the screen, which of these items are not factored into insurance rate premiums? Is it your driving record? I said not factored, right? Driving record, height, auto racing, which is a risky activity, or hair color, right? Of these four items, and it's kind of obvious that hair color would not be a factor that would determine the rate of insurance premiums. What about this list? Past health issues, religion, family history, tobacco use, right? So those things are various factors, but religion doesn't factor into the rate of premiums. And finally, this list of four items: riding a bicycle, prescribed medication, your age, your weight, right? Riding a bicycle would be the one here, right? So these are some factors that you could think about, but of course, not everything is factored when determining insurance premiums. So the next question is, how do you know how much insurance you need? Right? There are various methods. There are some quickie methods, but the dime method is one that's typically used, where you can calculate how much life insurance protection your family needs. So you buy insurance to have enough coverage for potential loss, right? No one would buy 100,000 coverage to cover a 500,000 house, or 20,000 to cover a 50,000 car, right? Likewise, you wouldn't want to put $100,000 of life insurance policy when you need 500,000, right? So how much do you really need? So here are some of the factors, right? Debt, right? Income, right? If you replace your income for at least 10 years, mortgage, you want to pay off the mortgage, education for your young ones, right? Those that are the younger kids, you want to make sure that their post-secondary education is paid for. These are some of the factors that could determine how you calculate. And we add all these up, and that would be an estimate of how much protection you need. And of course, there are some other things. If you want to add the charity or family expenses, those are some things that could also be factored in. Let's take a quick survey. We also always like to take stock of what we're doing and to find out what we're doing different. How could we make these workshops better? So if you don't mind, please scan the QR code on your screen and answer that quick survey when you have a chance. It's only 30 seconds to fill it out. But we want to know what your interests are so that we can better program future workshops. All right, we're just taking a little breather here. So please take a snapshot of that QR code on the screen. All right, let's pivot now into the types of life insurance. There are two main types of life insurance. There is term, and then there is permanent, right? So permanent can come in different forms. We're going to talk about whole life and universal life today. Main difference between the term and permanent is typically something called cash value. However, permanent could have no cash value, but it just means that it's permanent, as the name suggests. Term insurance is the simplest type of life insurance. Like renting an apartment, the insurance company will pay the death benefit should anything happen within the length of the term. So as term suggests, it's typically for a certain period of time. It can go up every year. That's called annual or yearly renewable term. It can be fixed or level for 5 years. It can be level for 10 years. It can be level for 20 years or other number of years. But what we can do is when we determine the number of years that we want to cover in a term policy, we can set it for level for that period of term. But of course, in the future, when we get to the end of that term, the premium will go up significantly sometimes because of the increase in age by the time that renewal is due. There are other types of term insurance coverage. For example, if you are at work, some employers do provide group life insurance, and that's always a term policy. And the benefit is usually about 1 to 3 times your annual salary. You do not need to qualify. It's based on the pooling of the group, and it's also very comparatively inexpensive. But the employer can change the plan at any time. And watch out, if the insurance provider by your employer may terminate when you leave the employment, it's not necessarily going to continue. And if you were to try to do that individually, the price might be significantly different, right? And then there's accidental death and dismemberment insurance. That's relatively inexpensive. The probability of accidents is kind of the same for everybody. So this is usually standard premium for accidental death and dismemberment, inexpensive. But of course, this only applies under certain conditions when you're meeting the factors of an accident that are in the coverage. Let's look at a term insurance policy example. And we're looking at, and these are only for illustrative purposes only, these are not exact, right? But for an example, a 30-year-old female non-smoker wants a $500,000 policy for 20 years, a 20-year term policy, right? So in this case, we're seeing that the annual premium is $400, right? So you can see on the screen that $400 remains fixed or level, as we call it, the level premium for 20 years. But as you can see, after 20 years, it changes, right? Let's look at the maths. First 20 years, it's predictable. $400 per year for 20 years, that's $8,000, right? So if that term ends and we continue to renew that policy, then the next 20 years, it will be over $2,000 per year. And in the next 20 years, it will be over $90,000. So in total, we will have paid over $100,000 for that premium after 40 years, right? So we have to be careful that we determine the right level of term policy and how much is the right mix. So let's look at the pros and cons. There are different advantages for term insurance. First of all, of course, is the low cost, relatively inexpensive, does give you protection. This is better than nothing. If your budget only allows term insurance, then obviously go for it and make sure that we have some coverage in place for that period of time. And make sure that we add up all the assets and the liabilities that we need to cover for the right amount of time, right? If it's your mortgage, it's typically 20 to 30 years. Other debts, loans, lines of credit, we make sure we add all those up so that the liabilities are paid off in case of something happening. Disadvantages: it's only insurable for a specified amount of time. Policy will lapse if the premiums are not paid as scheduled. The premium is wasted if you don't die within the term, and becoming uninsurable forces you to renew at high rates, and policy cannot be renewed beyond the maximum age. So those are some of the disadvantages that are typically associated with a term insurance policy. How about a permanent solution? Because term insurance is set for a period of time, you may live longer than the length of term, right? And how long do you think you will live? Think about how much debt, loans, mortgage, or other financial burdens will be passed on to loved ones. Who will pay for that bill? Permanent insurance has a place, right? So there's place for both of these. If term insurance is like renting an apartment, permanent insurance is like owning a home. There is cash value associated with the account that can potentially generate interest to help pay for a higher cost of insurance as you get older. So when it comes to permanent policy, the cost of insurance goes up every year, right? So, as we age, the cost of insurance continuously increases, as the purple line shows. So all it means is that when we try to do a level term, we'll pay some upfront. If you want a level permanent policy, then you will have a fixed amount, a higher amount at the front end, so that it will average out over the lifetime of the policy, right? So, but ultimately, we'll have to pay for those higher costs of insurance in later years at some point. All right, so what are our choices when it comes to permanent insurance? There's whole life and there is universal life. And universal life can be variable universal life, or it can be index universal life in the United States. But typically, these are the two buckets of permanent life insurance coverage. Let's look at whole life first. Whole life is pretty much the original type of insurance policy. You get the key, you get policy to keep for your entire life, as the name suggests. Part of your premium purchases insurance that can be sold back to the life insurance company, creating cash value. Right? So not all whole life policies do have a cash value. There can be non-cash value whole life policy, but at least you have coverage for your entire life. So what are some of the elements of whole life insurance? It's fixed level premium for life, right? So it's fixed, stays fixed for the period of time that you decide to pay for it. Either pay for 20 years, pay until the age 100. There are various ways to design the policy. And the cash value is typically more conservative because that's through the insurance company that has the guaranteed interest rate. So they do offer typically some guaranteed cash values. Cash value accessible through withdrawal, surrender policy, or taking a policy loan. The policy may receive dividends, profit back, which can be, help to lower the premium by insurance or at cash value, right? To be paid back to the owner, right? So we can receive the dividends as cash, or we can pay up to buy more insurance for the future to cover inflation. All right, so let's look at a whole life insurance policy for the same 30-year-old female non-smoker that we talked about earlier, right? Last time we saw it was $400 per year. So typically for a whole life policy for coverage for your entire life, it will be more expensive. So for the same coverage, we're looking at $527.85 per month, which is $6,000 per year. Right? So significantly higher premium than a term policy, as we said before. And so in the case of a whole life, in this case, it's building up cash value as shown here, right? Some of these are guaranteed, some are not, right? Based on the prevailing dividend rate that the insurance company has for that policy. So after 20 years, right, this would have an increased death benefit. We are buying additional death benefits. So we started out at 500,000, but after 20 years, unlike the term, which would still stay fixed, we could buy additional insurance and we'd have some cash value build up. In this case, we're saying $167,000, right? So by 20 years, you would have paid in $126,684 into the policy, but you would have had this cash value that is built up as well as higher life insurance coverage, death benefit. By age 65, you would have death benefit of $1.1 million and over $500,000 in cash value. So the benefit accrues in growing the death benefit, so that will cover for higher cost of inflation, as well as the cash value is something that you can use during your lifetime, whether through policy loans or withdrawals. So let's look at the advantages and disadvantages of whole life. Guaranteed interest rate. All right, you can pay for a period of time. It could be a 10 pay, 20 pay, or pay to hit age 100, and you can design it prior to issue the policy. Permanent policy designed to last your entire life, and it has tax advantage growth. In other words, the cash value grows tax deferred. There won't be any statements for your tax return at the end of each year, grows tax deferred, and there are ways through policy loans that you could get it tax-free later on. Disadvantages: guaranteed interest rate tends to be more conservative, and the premium is fixed. Right? There's no flexibility in premiums that you pay. Let's look at universal life insurance. So universal life insurance is similar to whole life in the fact that it's a permanent policy. However, it has a flexible premium with minimums and maximum that can be paid each month or year, right? So again, cost of insurance is always going up, but in the case of a universal life policy, you can have some flexibility in how you pay the premiums, right? These have to be properly designed, and we have to make sure we have enough cash value built up. But the premium can be flexible in case of hardship, or if you get additional sums of money later on, you can put more into the policy. All right, so with universal life, it's like a hybrid between whole and term, designed to last your entire life, does have flexibility with minimums and maximums that you can pay into the policy. It allows flexibility of the investment choices. You can choose more, you have more flexibility in choosing the investments you want to be put, the cash value to be invested in, including stocks and those types of things. And you can access the cash value through withdrawals or a policy loan. And the way universal life works is that some of the premium pays for the cost of insurance, but the rest gets invested and indexed to third-party investment funds. Let's look at an example for universal life policy for the same $500,000 for the 30-year-old female non-smoker. In this case, we're looking at the same 500 roughly that we paid for the whole life policy. However, we're going to put this to work at 6%. We're going to assume a growth rate because we're going to put the investments in some funds that might average around 6% per year. And that's a little bit more growth oriented than the whole life policy would be. So what we see is after 20 years, you'll have higher projections for cash value. And then the 708,000, as you see, that you can also purchase additional premium, additional insurance every year. At age 65, same things occur. You'll have over $500,000 at 6% rate of return. Average over the period, you will have over $1 million of death benefit, as well as over $500,000 projected of living benefits. Again, that cash value or living benefit can be accessible for helping supplement retirement, could be used for long-term care. Anything that you want to use that for is possible, right? And again, a lot of times we recommend taking a policy loan to avoid the taxes. Flexible premium, right? You can make adjustments, right? Again, we have to make sure the policy stays paid up, but there's some flexibility in case of hardship. Sometimes there's some holidays I can take from it or lower the premium for a period of time, but you can also increase it if you want to put more towards the cash value. The permanent policy, again, is designed for your life. You have access to that cash value while you're alive, and then there's tax advantage growth in this one as well. Drawbacks: you have to be careful that the policy doesn't become underfunded, which can cause additional premiums later in life. It has to be properly designed and monitored so that we don't have any surprises. And then the interest, can be more conservative. If you want guaranteed interest, definitely you have the flexibility to also invest in more conservative, places, but it won't necessarily give you the better returns. So if we look at the comparative, let's look at a little quiz here as we wrap up this differences between term, whole life, and universal. Let's look at this first question. Term insurance has flexible premiums, and you can skip payments without policy lapse, right? So term insurance typically has a required premium each month or year, and you cannot skip it. You have to keep paying the premiums or else your policy may lapse. There's no cash value to pay it up if you miss a premium. Second question, future term insurance renewal rates are lower, right? Future term insurance renewal rates cannot be lower because as we get older, cost of insurance goes up. So later on in life, in later years, when the renewal comes up, it will likely be much higher than when you started. Group term insurance from your employer may terminate if you leave their employment, right? Yes, if you leave an employment, their group term insurance plan may terminate. You could possibly opt to take it out on your own, but it will be more expensive than you're paying with a company group plan. Final expense is a type of term policy. Final expense is typically a whole life policy or some form of permanent policy because you don't know when that final day will be. And then finally, universal life has a flexible premium. We did say that's true. So universal life does have some flexibility in the premium. That's one of the characteristics of universal life policies. So in addition to the benefits that we talked about, there is a concept or a term called riders, where we can add on other things to the policy. Some of the companies will allow you to add on other things. It could be additional term coverage, critical illness, disability coverage. Some of them have child rider, guaranteed insurability, and waiver of premiums if something happens to you. One of the other benefits of life insurance, as we said before, there is some tax advantage life insurance, but all of the death benefits for any life insurance policy, whether it's term or permanent, is tax-free to the beneficiary. So that's a great benefit. And if you have been living benefits along with the policy, there's cash value in the policy. It can be tax-free, right? As I said before, tax-deferred growth on the cash value in permanent policy, right? There's no tax you have to report at tax return time each year. It grows tax-deferred. And income tax-free access to the cash value in permanent policies. If you take out a collateral loan or a policy loan from the cash value, that is typically tax-free, and it could help to do something else while you're alive. And tax-free withdrawals can be done because if you withdraw the premiums that you paid, it could be tax-free. However, it may reduce the death benefit, and of course, the interest may be taxable. All right, so about insurance for others. What about insuring children? Difficult subject too. What if your child becomes critically ill or the unthinkable happens, right? Being prepared could lessen potential financial burdens so you can focus on what matters, right? What about homemakers? Our stay-at-home parents, should they be insured, right? Right? So their importance and role in the household often gets overlooked and undervalued. If they're not around to do that, somebody else would have to be paid to do it, most likely. Single people, do you care for your parents? Does anybody depend on your income, right? Those are some questions you need to ask. Do you have an active lifestyle? Are you uninsurable? Have you looked into non-medical or guaranteed issue options? There's always some insurance that's possible, but it might be limited in coverage. Cost concern, right? So if you are worried about paying your final expenses, how does a final expense coverage enhance your plan? Those are things you could consider. All right, let's look at insurance for children. What kind of parent will insure their children, right? Don't like to talk about. That's a very awkward subject or tricky subject. What if your child becomes critically ill or the unthinkable happens? Would you be forced to go back to work the next day to continue to pay the bills, which never stop? Or could you take care of your family and grieve properly without the financial burden, right? If you can, it can, so this type of insurance can be used to protect the parent's income. You could stay at home to take care of the sick child if they had proper critical illness coverage. And how much money would they spend on the best treatment if they're or better treatments out there, you may have some funds that you could pay for a better treatment somewhere else. Um, right. So the good thing about children is that insurance is typically much easier and less expensive when they're young and healthy. Is that the gift that you can give them to keep their entire life and becomes part of the legacy you leave them, right? So you could definitely lock in lifetime coverage for a child that they could have protection regardless of what happens to them later on in life, whether they get some illness that make them uninsurable, but you will have some insurance in place that could be a legacy or a gift that you give them. All right, let's look at critical illness. All right, so we own life insurance if we pass away too soon, but what if we get critical ill and survive, right? In Canada, we have lots of things that get covered with our insurance, but certain critical conditions can keep us in hospital for or off work for a longer time, and the bills don't get paid, right? Or uh, insurance may cover certain things, hospital care, prescription drugs, but it won't pay for the bills that don't get stuck. If we can't show up for work, then the bills will still need to be paid to make sure that we have protection in place for that. All right, so there are sometimes other benefits of critical illness policies. Sometimes some of them come with second opinion type coverage where you can get second opinions from another doctor. What about disability insurance? What if you become disabled and cannot work? If you become disabled because of sickness or injury, having a disability policy could help you pay the monthly amount on the bills that you need to continue paying. Typically, it's up to 60% of your net income. There are typically employers who have group plans that will pay out the first. Those will pay out first before your individual plan kicks in. But again, you can still pay the bills if you cannot go to work, especially if you have a job or you own a job, self-employment. If you're a business owner or self-employed professional, do you have the safety net if you cannot work for an extended period of time? Can your savings last 1, 3, or possibly 10 years? Yes, you need to protect your income. You don't want to go into debt because we can't show up to work. What about health and travel? There are other types of insurance. Health insurance, travel insurance, right? Covers you if you go outside of the country. And health insurance, what about if you become retired? How do you cover health insurance? So those are some of the things you can look at for coverage, other types of insurance. Then there's mortgage insurance. Mortgage insurance will pay off your mortgage if you should become seriously ill or die. Unfortunately, it's not clear cut as life insurance, right? So depending on the lender, they might, give you coverage, but it might have some conditions applied to it, which may be grounds for denial. So we have to be careful when you take out mortgage insurance, make sure you read the fine print. And there's simplified issue insurance. These are offered especially if you have already been declined because of some health reason. These have less medical questions. Typically, premiums will be a bit higher, but it will be less onerous. Not as much underwriting as a typical life insurance policy that's fully underwritten. Then there's also guaranteed issue life insurance, where there's no medical exam and it's a much simplified underwriting, and sometimes they're available up to age 80. All right, so let's look at some frequently asked questions. Does my life insurance through work cover me? Of course it does. Your employer may provide this benefit. However, you may not allow you to take it with you if you leave their employment, right? So it covers you while you're employed to them. And typically the coverage is not usually enough to cover all of those debts and replacing income, as we talked about before. Why is it so cheap? Why is it costly? As we talked about, there are many factors that affect the premium that is determined for a life insurance policy. If you're in good health and non-smoker, those will typically cause you to have a lower insurance. If you smoke, if you have some health conditions, it may increase the cost of insurance. So we could think of the strategy questionnaire And just think about these questions and would it be yes or no for you? Do you think your health will change as you get older? Right? Those are things we need to worry about because, again, some things might make us uninsurable. Do you have a strategy that addresses your responsibility? In other words, yes, life insurance is needed if you don't have enough money to cover your responsibilities. You could have a big nest egg or inheritance that says, okay, you have enough to pay, keep paying, for your bills. If you pass away, your loved ones will be taken care of, but typically we transfer the risk to somebody else at a much lower cost. Do you want benefits that help you with overall financial strategy? Will you be self-insured during your retirement years? Again, if you build up enough of a nest egg or estate, you could become self-insured, but sometimes we still want to pass on some of that risk to somebody else at a much cheaper cost. Will you consider estate taxes? Right? A lot of the assets we have in our estate could be taxable on our final tax return. So we want our loved ones to sell the assets to pay the taxes, or do we want to have uh, life insurance in place to pay those taxes that may become due? Do you want to pass on wealth to the next generation? You might want to leave a legacy for your children or grandchildren. Right. So if you think about it as we wrap up here, which match the type of policy with the description, right? So a policy for life and with a guaranteed rate, which one is that? Limited income but wants protect family, right? So if you have a tight budget but you still want to have some protection in place, which one would that be? What about a policy for life but have some flexibility, right? So we covered all these things. So the term policy is the one that you have much lower premium, so you can definitely do it on a lower budget. Whole life policy will give you policy for life at a guaranteed rate, and then universal life with a policy for life but flexibility in place. All right, so that's it, guys. Hope you had some things that you learned today. Our next step, as usual, we don't want to leave here without developing an action plan. If something in this workshop, um, piqued your interest, let's do that quick survey again and make sure that we get the right answers. You have the power of choice, right? It's important that you work with a licensed professional that represents many different well-known insurance provider and products so that you have choice. And scenarios can present it. Solution will be based on your needs. We can tailor the solution to your need, not just sell a policy because that's the only thing on the menu, right? And you want to have a holistic approach, right? There's a place for term policy, there's a place for permanent. So a lot of times it's a mix of both, right? It's not a one size fits all, right? So the days of insurance salesmen trying to meet their quota are over. You have more knowledge today. There's lots of resources out there, workshops such as this one, and you can make sure you become more informed, educated, and empowered to make the right decisions, or at least ask the right question. There are tools out there, such as the expert financial analysis that I provide, but it helps to determine the need for what you need for protection, how to pay off your debts faster, and you get a report on the amount of money you need to live the lifestyle that you desire during retirement. So you can enjoy what really matters. So as usual, please bring somebody to the next workshop. You can scan the QR code on the screen to see what upcoming workshops are in the pipeline. We have these advertised on Eventbrite. Our next workshop will cover growing your financial assets live next time. Thanks for attending. Please scan the QR code on the screen if you want to meet with me, but speak to the person who invited you or scan the QR code on the screen. Bye for now, guys.